The most recent inflation report is in. Mortgage demand continues to fall. The Federal Reserve doubles down on their mission to control inflation in their internal meeting in Jackson Hole, Wyoming, and mortgage rates are back to historic highs. What's up guys, this is Oliver, your Bay Area Realtor, and for today's video, we're going to be looking at the current mortgage market for September. To break down this video, first we're going to review the most recent events in the mortgage market and see how it has affected mortgage demand as a whole. Specifically, we'll be reviewing the newly released inflation report and the Federal Reserve's internal meeting in Jackson Hole, Wyoming. Second, we'll review today's rates, and lastly, how this will translate to your buying power in the Bay Area. If you're new to this channel, my name is Oliver. I'm a realtor in the Bay Area, and I create content on the latest news revolving the real estate and mortgage market nationwide, and how that ultimately impacts our beloved Bay Area real estate market. Before we begin, if you enjoy me making these videos, I'd appreciate if you like this video. This will help support my channel and home buyers like yourself who are looking to buy a home in the Bay Area. If you want to stay updated with the Bay Area real estate market, you gotta subscribe to my channel. What are you guys waiting for? So with out of the way, let's cue up the intro. Guys have been living under a rock for a few weeks. We've received a lot of news for our mortgage market. Specifically, we had the most recent inflation report released by the Department of Bureau and Labor Statistics. And also we had our meeting in late August from the Federal Reserve when they had their internal meeting in Jackson Hole, Wyoming. So we can start off with going over the most recent inflation report that was released this past Tuesday. There's a really good article by Reuters or Reuters. You guys got to tell me how to pronounce that in the comment section below. But they had an article. They have an article here titled "Fed Seen Getting More Aggressive as Inflation Roars." So September 13th, the Federal Reserve is likely to raise U.S. borrowing costs faster and further than previously expected after data on Tuesday showed underlying inflation broadening out rather than cooling as expected. Overall, consumer prices climbed 0.1% last month from July. Economists had expected a decline and gained 8.3% from the year earlier period, the Labor Department reported. The data also showed accelerating inflation in services and a particular worrisome rise in the cost of rent, which tends to be sticky from one month to the next, making the Fed's inflation fighting job all the more difficult. So according to the Department of Bureau and Labor Statistics, our inflation for the month of August is now 8.3%, when the economists expect it to be 8.1%. Still though, our current inflation is now lower than in June and July, but since it was still higher than what the economists and a lot of people predicted, it is something to be worried about. So you see right here, I'm on usinflationcalculator.com, and they have the inflation rates all the way back to 2000. So right here, the annual inflation rate for the United States is 8.3% for the 12 months ended in August 2022, after rising 8.5% previously, according to the U.S. Department data published on September 13th. The next inflation update is scheduled for October 13th on 8:30 a.m. Eastern Time. So you see right here, United States annual inflation rates 2012 to 2022. 2012 it's 1.7, and you see it go from 0.8, 0.7, which is really low inflation, up to 2.1. And then 2020, during the pandemic, it dropped to 1.4 and then spiked up to 7 in 2021, and then 8.3 now. The Federal Reserve's mission is to make sure that the inflation drops back down to around the range that it was in 2016 to 2019. You can see right here, month to month, January in 2022, it was at 7.5, February 7.9. You see it just continue to increase until June, when it reached its highest at 9.1% inflation. and now it's dropping slowly down to in August, but still not meeting the expectations of the economists. We'll see what the numbers are for this month in September on October 13th to see, if these interest rate hikes are going to continue dropping down our inflation, or is it going to remain the same or possibly increase? So on the topic of the Federal Reserve's mission to maintain inflation down to 2% year to year, the Federal Reserve had a internal meeting in Jackson Hole, Wyoming, where they discussed the outlook of the economy and how to move forward to control inflation. There's a good article by the Forbes titled "Jackson Hole, Fed Chair Jerome Powell Talks Tough on Inflation." The Federal Reserve Chair Jerome Powell is serious about crushing high inflation. Whether he actually succeeds and how much collateral damage there is along the way is an open question. Powell reiterated his vows in his third speech of the COVID era during the Jackson Hole Economic Policy Symposium on Friday. It was his first in-person talk since 2019. 2 years ago at Jackson Hole, Powell's speech made the case for letting prices rise above the Fed's 2% inflation target. Last year, he argued that inflation was transitory and would fall quickly. Now his thought process has changed. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. The burdens of high inflation fall heaviest on those who are least able to bear them. With inflation above the Fed's target, economic growth slowing, and unpredictable geopolitical events wreaking havoc on the global economy, Powell will have to maneuver nimbly if he wants to deliver a more sanguine message at next year's symposium. So this internal meeting in Jackson, Wyoming was to emphasize their current outlook on the economy and that their mission right now is to deliver strong monetary policies to control inflation and get it back down to 2%, which is their overall goal. Now let's look at how all this news has infected US mortgage interest rates. There's another article by Reuters. I'm just going to start calling it Reuters from now on. It's titled US mortgage interest rates top 6% for the first time since 2008. Starting from the top, the average interest rate on the most popular US home loan rose above 6% for the first time since 2008. Wow, so guys, we haven't seen these kinds of rates since 14 years ago during the financial crisis in 2008. And right here it says it's now more than double the level it was 1 year ago. This is all according to the Mortgage Bankers Association when they had their press release on Wednesday. Rising mortgage rates are increasingly weighing on the interest rate sensitive housing sector as the Federal Reserve pushes on with aggressive lifting borrowing costs in order to tame high inflation. The central bank has raised its benchmark overnight lending rate by 225 basis points since March. Expectations for Fed tightening have led to a surge in Treasury yields since the start of this year. The yield on the 10-year note acts as a benchmark for mortgage rates. So in my previous videos, I talk about how the 10-year Treasury note is a great benchmark to look at to see where the trajectory of mortgage rates are going, because they kind of complement each other and move in parallel. But the yield doesn't always follow the increase of the federal funds rate. In the beginning of the federal rate hikes that would occur a few months back, when it began, yields of Treasury did go up along with mortgage rates because it was this is when it initially started. So the banks and the yields were reacting to whatever the Federal Reserve was doing. When the Federal Reserve continued their increases for the past two other meetings, they already expected the increases, so the markets didn't react that much to the news. So it's just something to think about. Having the increases from the Federal Reserve for the federal funds rate does not mean exact correlation to the 10-year note or the mortgage rate interest. So back to the article, the average contract rate on a 30-year fixed rate mortgage rose by 7 basis points to 6.01% for the week ending in September 9th, a level not seen since towards the end of the financial crisis and Great Recession. The MBA also said its market composite index, a measure of mortgage loan application volume, declined 1.2% from a week earlier and is now down 64% from 1 year ago. So our housing market was really hot in 2021. So I am not surprised that our mortgage loan application volume has dropped 64% from its highs in 2021. But it is still steadily decreasing week to week. We have a mortgage division in Selective Realty, and to be honest with you, we are seeing a slowdown in application volume. We're doing less loans now, especially for refinance. Right here it says its refinance index fell 4.2% from the prior week and was down 83.3% compared to 1 year ago. So not a lot of homeowners are considering refinancing at this time because it doesn't make sense. A lot of people have refinanced their homes during the lows of the pandemic when the rates were, I would say like 2%, even lower than 2% sometimes. A worse than expected key inflation reading on Tuesday cemented expectations the Fed will be forced to deliver a third straight 75 basis point interest rate hike at its policy meeting next week, with investors now predicting the central bank will have to hike rates higher and further than previously thought. The impact of higher rates is being felt across the housing sector. New home sales plunged to a 6.5-year low in July, while home resales and single-family housing starts are at 2-year lows. Housing prices remain elevated amid a critical shortage of affordable homes, making a housing market collapse unlikely. There's still a shortage of housing inventory. In the Bay Area, we're looking at around 2.4 to a little under 3 months of inventory. For a healthier market, we would have to see it around 4 to 5. And then to shift to a buyer's market, it will be around anything above 6 months. But overall, a lot of people are predicting that there will be a 75 basis point interest rate hike. I have this really cool website that I use, cmegroup.com. They have this cool feature where they predict the probability of where the target federal funds rate will be for the next Fed meeting. So for the next meeting is September 21st, 2022. They predict that there's an 80% probability that the next target rate will be 300 to 325. And there's a 20% probability that would be 325 to 350. So whole consensus is that it's going to increase. No doubt about it. But now it's just the degree, how much of an increase it will be. Will it be less than 75 basis points or more than 75 basis points? So let's briefly look over the mortgage market indexes that I have. First, starting with the composite index. So mortgage application volume in the United States decreased 1.2% to 255 points in the week ending in the September 9th, a fifth consecutive decline at the lowest levels since 1999. As interest rates continued to go up, applications to refinance a home went down 4.2%. Offsetting a 0.2% rise in applications to purchase a home. So you see right here for 1 year, this is a 1-year chart. You see application volume has dropped to the lowest of the whole year. We can look at 5 years. It's the lowest in 5 years. 10 years, lowest in 10 years. And like they've mentioned before, since 1999, it hasn't been this low. We look at the purchase index. The purchase index in the United States decreased for 0.2% in the week ending in September 9th. So it has increased slightly from the previous week, but it's still at the lows of the year. And we look at 10 years, we haven't been this low since the pandemic, when the pandemic was actually lower. But that's still something to consider with buyers not buying homes. There's a huge slowdown. So yeah, we're seeing a huge drop right now. Refinance index in the United States decreased 4.2% to 532.9 points in the week ending in September 9th. This is the lowest reading since 2000. You see right here, 2000 right here. So refinances have had a huge slowdown. So now let's look at the US 10-year Treasury note yields. Right now it's at 3.451%. Let's look at how it was for 3 months. As you can see right here, it has surpassed the yields that were in the middle of June. This also correlates to how the mortgage rates were also really high in June, but now it's surpassed that. So if we look at the year to date, it is right now at 3.451%, and it's still a little bit less than its highs for the year of June, middle of June, when it was at 3.48%. Now let's see how that has correlated to interest rates, mortgage interest rates. Here are the rates today, guys. Bear with me, okay? Don't get sad. You know, this is just a normal market. This is a normal market. Real estate market always expands and contracts. That's how they work, how they operate. So, you know, it's okay. Okay. So 30-year conforming. So the current rates right now, you can access this through our website, selectiverealty.com/mortgage-loans. Okay, so the current rates right now for 30-year conforming is at 6.124%, 30-year jumbo 5.821%, 30-year FHA 5.9%, 30-year VA 5.7%, 30-year USDA 5.955%, and 15-year conforming 5.283%. Let's look at the trends. For 30 days, the trend has been going up. 180 days, we have reached probably the same as what it was in June 14th. No, now it's higher for the 30-year conforming. Yeah, pretty much everything, all the products, all the loan programs across the board have increased higher than its highs in June 14th. And this is alarming, you know, with the Federal Reserve continuing to increase their interest rates. I don't know how the markets are going to react, but I do see interest rates definitely going to go up in the near future. So we're going to have to just take a breather and wait and see how this is all going to unfold. So now let's do something fun and look at a real life example to see if we're going to buy a house in the Bay Area, what is our buying power and what would our monthly payment look like for a home in the Bay Area. Let's look at San Mateo. So right here we have this beautiful Eichler in San Mateo, California. The list price is $1.798. It's a 3-bedroom, 2-bathroom, 1,400 square foot home. Let's take a little peek in here. See how it looks. Not bad. Kitchen. Everything looks remodeled in here. Has a nice island. The island has a nook, so it has some breakfast bar feature in there. Dining room looks nice. This beam looks kind of off. Kind of is off-putting. But moving on, the living room is nice. Has a nice fireplace. So this is an overall nice home. So 1.798. So now let's look at our mortgage calculator here on our website. This will help determine how much our monthly mortgage payment will be, and also what is our estimated housing payment entirely. So let's look at conventional 30-year loan. The price was $1,798. Down payment, let's stick with 20% standard. Interest rate is not 4%. It is 6.124%. Okay, so our P&I for this San Mateo home is $8,738. Taxes will probably be around $1,800. Hazard insurance is about $824 monthly. So your total monthly payment is going to be $11,361. So take note of that, okay? So 1 year ago, it was at 3.032% for a 30-year conforming. So let's change it, 3.032%. Your monthly payment 1 year ago, if you were to buy this house, would be $8,711, and your P&I will be $6,089. and this will be at 3.032% approximately 1 year ago in September 2021. So the difference in housing payment and in P&I is ranging from around $2,000. So the increase of the interest rate from 3% to now 6% has drastically impacted your buying power, where now you have to pay $2,000 more every month to own the same house than approximately 1 year ago. In summary, inflation is now at 8.3%, higher than the expected 8.1%. Inflation is still at an all-time high, and mortgage rates are at its peak since the middle of June, and it hasn't been this high since 2008 during the financial crisis. The Federal Reserve is ready to continue their federal rate hikes. With the international politics situation, I do see the federal funds rate increasing to 300 to 325 basis points, and I predict mortgage rates will continue to creep up, slowing down our market. In the Bay Area, we are decelerating. If you haven't watched my Bay Area market video for September, homes are taking more time on the market. Sales have dropped 36% on average for all of your major counties: Santa Clara County, San Francisco, San Mateo, Alameda, and Contra Costa. So I hope this video gave you some perspective on today's mortgage market. I recommend using our mortgage calculator to get a better understanding of how much it costs to have a home in the Bay Area. If you found this video informative, please like and subscribe, and don't forget to hit that bell icon to stay updated with all things real estate in the Bay Area. I'll see you guys in the next video.